good morning, everybody, and welcome to this event organized by the Center for Public Understanding of Finance. My name is Ali Ataullah. I'm a professor of finance and the director of the center. Now, to find out more about the research that our center's members do and the teaching resources that we have on corporate finance and personal finance, please visit our center's webpage. On behalf of all the center members, I would like to thank you all for being here today. Now, please note that this event is recorded, and the recording will be shared via Business School's YouTube channel and via emails. Now, I'm really delighted to introduce our presenter today, Christopher Mahon. Christopher is a fund manager at Columbia Threadneedle with over 25 years experience. He's based in London, where he leads the dynamic real returns team, which specializes in technical asset allocation. He previously led the multi-asset team at Barings. His clients include institutional investors such as sovereign wealth funds, pension schemes, endowments, and charities. He holds MA from Cambridge University and is also a chartered financial analyst. More importantly, Christopher is also our visiting fellow for the Center of Public Understanding of Finance. So we are really delighted to have you here, Christopher, today to talk to us about ESG metrics. Now, before we start the presentation, I would like to invite Dr. Rodion Skovoroda, who is a co-director of our center, to say a few words about the importance of ESG metrics. This will set the context of the presentation today. So once again, thank you all for being here, and Rodion, over to you.
Thank you, Ali. Thank you. So before handing over to Christopher, I wanted to say a few introductory words about ESG investing. So recent reports indicate that global ESG assets under management surpassed $30 trillion. It's a huge sum. ESG in ESG investing stands, of course, for environment, social, and governance factors, representing firms, assets, or even countries that strive to be environmentally sustainable, socially responsible, and well-governed. So the demand for ESG assets generally come from two types of investors. Some investors choose ESG-ranked assets to express their non-financial values and preferences regarding social, environment, and climate change issues. In contrast, other investors see ESG investing as a way to mitigate risks and enhance financial returns of their portfolios. So in response to this demand, fund managers cater to both types of investors by offering various approaches such as ESG integration, positive ESG tilt, negative ESG screening, and ESG risk management. So talking about risk management, investors may be concerned about the direct physical risks, but also opportunities associated with climate change events, such as floods, hurricanes, or droughts. Investors may also be concerned about the long-term risks that firms face in transitioning to a lower carbon economy, including new carbon taxes and the associated changes in market conditions. In other words, the future of green transition relies crucially on financial markets playing an active role in helping investors handle, reduce, and hedge these risks. Of course, making this happen means we need reliable metrics of climate change risks and ESG performance at both the firm but also country levels. This is a very important point that I wanted to highlight. And with this point in mind, I'll hand over to Christopher, who will tell us more about ESG integration and the way investors can incorporate ESG metrics into their long-term capital markets forecasts. Thank you.
Well, thank you, Ali and Rodion, for that very warm and comprehensive introduction, which sets the stage very well for what I'd like to talk to you about. So to introduce myself, my name is Christopher Mahon. I've been working in financial markets for 25 years or so. And as Rodion just pointed out, one of the remarkable features in the last, in that quarter century has been the rise of interest in ESG and responsible investing more generally. And my purpose here today is to talk to you a little bit about some of the experiences I've had as an asset allocator in the industry of how we use some of those frameworks to help make investment decisions. I do have to share the disclaimer as well. I work in a regulated industry, so it's very important to show these disclaimers. I will let you read it in your own time when the materials are sent out at the end. But I'd like to start off with an audience poll to warm us up in terms of how do we think we should, as investors, try and incorporate ESG factors. And in general, there are two ways of doing this. There is incorporating those factors into the companies that investors end up buying, companies like Unilever or Tesla, etc., or at the country level. The countries obviously make the rules by which the companies have to behave by. And I think it's an interesting question to see where this audience ends up, to see whether it is on the company side that we think has the greatest onus on incorporating those factors, or on the country side. So if we could just try a little poll first to see where our preferences lie at the beginning of this session. Okay, well, maybe we can come back to it at the end. But suffice to say, most people and most research out there works and is focused on the company level, and most people out there, most firms, most investors, most of the metrics that are used in the industry are company specific, and I would say almost 95% of the work that I see in ESG is at the company level, and this is big business now. Providing the data that Rodion talked about is big business. There's huge amounts of databases that investment firms like my own subscribe to. There's huge amounts of work done at the company level. But what I'd like to talk to you today about is a road which is less traveled, and that is looking at country data. Now, as I say, this is a minority sport in some senses. Many people are thinking about ESG at the company level. But I'd like to talk to you about how country level data can help improve investment decisions, and how that is a way of dealing with the huge challenges that we as a world face. Now, there's a reason that I choose countries, and that is because my background is in asset allocation, and that is in contrast to what much of the industry is about. What much of the investment industry is about is focused on stock picking. So stock pickers are the people who distinguish between investing in Amazon or in Facebook, etc. They try and work out whether it's Unilever, which is the best investment, or whether it's Nestle, etc. The stock pickers are focused on that company level information. My own background is in asset allocation. And I think asset allocation has a real opportunity, which is not yet mainstream, to incorporate ESG into investment decisions. And the reason that I think there's a great opportunity for asset allocators to do this is because asset allocators, as a group of people, tend to believe in long-term forecasts. In other words, asset allocators tend to think that the short term is very noisy, but the long term we can distinguish the trends, and those slower moving issues, typically around environmental, social and governance issues, fit in very well, I believe, into those long-term forecasts. And so today I'll be talking a lot about long-term forecasts, because I think that is the unique opportunity that asset allocators have to include ESG into their investment decisions. So my next slide just tries to make the point that pretty much most investment firms out there publish long-term returns. And these return forecasts are typically published by the asset allocation teams. And they typically look out perhaps a decade into the future. And whether it is BlackRock, which is the biggest investment firm in the world, whether it is Schroders, whether it is Barings, whether it is some of the other houses out there, they typically all publish these return forecasts, which take into account very long-term trends, which take into account things where I believe ESG can be fitted in. Now, everyone has their own methodologies, but because BlackRock is the biggest firm out there, I thought it'd be fair to have a look at the BlackRock long-term forecasts, just so you can get an idea of what one of these forecasts look like. Not because I think it's anything particularly important about that way the BlackRock do it, but rather just as a discussion to see what these long-term forecasts tend to look like. So at the bottom, you've got the fixed income asset classes. They're in yellow. And you can see the return projections that this asset allocation team reckon things like long-term government bonds might have. And as it goes up the risk curve, you can go from long-term government bonds into areas like inflation-linked bonds. And then at the top of the yellow bars, you can see things like high-yield debt and emerging debt. So those are the fixed income asset classes that BlackRock here are projecting. The little round dots are what they think are the expected returns over the next 10 years. And then the bars around it are the spread of returns that their modeling has come up with for different types of scenarios. Above the yellow bars, you've got the equities. They generally typically have higher expected returns, as you might expect, than fixed income. So the green dots are a little bit higher. And the spread of returns, because they are more volatile, you can see that the bars are a bit wider. And at the very top, you have the unlisted asset classes, things like private equity, real estate, etc., which are not listed. And I probably will talk about it a bit less in this session. But the point is that behind each of these dots, each investment firm has typically had to make a whole heap of assumptions about how the world is going to look in the next 10 years. And the types of assumptions that they might have to think about include things like demographics, include things like globalization, and I believe into that framework we can put in sustainability. So just as an example of what one of these issues might be and how this might translate into return forecasts, let's think about demographics. Japan has famously very poor demographics, a very aging population, and it is also famous for having some of the lowest inflation readings in the world. Partly as a result of the Japanese experience, many people out there think that bad demographics, aging populations, go hand in hand with lower inflation readings. In other words, there are people, in other words, there is a view that a long-term trend, in that case being demographics, translates into an economic environment, inflation, which has obvious knock-on implications for how things like policy, central bank policy, and how things like government bonds might react. So I'm going to dive in a little bit more detail on how that framework might look. And I just talked about the example of demographics, but each investment house, when they make those long-term decisions, those long-term forecasts, they will be using a framework which is not that dissimilar to what I've written on this slide. Of course, each house has its own secret sauce, as it were, about how they like to do these things. Each house has their own approach, but many of them share this type of behavior. So they will start with things like demographic trends, things like productivity trends. They will layer on policy assumptions. We just talked about the central bank and what that might mean to low inflation readings. Obviously, those policy assumptions have implications for how certain financial markets might behave. In particular, if central banks have low rates, have near zero rates, that probably means something for the bond market. And then at the far end, you have how corporates behave or are likely to behave given all of what we said about the economic and policy and market environment. So there are a whole heap of assumptions that are going to be made to come up with that bar chart like the one I showed from BlackRock. There are a whole heap of assumptions which are going to be made. And my purpose today is to try and examine some of those assumptions to show how ESG can be linked into making those return forecasts. And I'm going to talk about two examples. I'm going to start with an example from the world of corporates, from the world of equities. That's at the bottom right in the sales forecast, sales growth assumptions. And hopefully, if we have time, we'll also talk about an example from the bond market. And as I say, the idea is to show how incorporating ESG can actually help improve the way that these assumptions are put together. So first example comes from the idea of economic growth and how that might translate into revenue growth. Most people have a view, a sort of conventional wisdom, if you like, that higher economic growth is generally better for corporates, in particular for their revenues, for their profits, and ultimately for their dividends. This is sometimes held out almost as automatically being true. And I would like to just question how true it is and whether or not there are certain assumptions or certain scenarios under which that conventional wisdom comes under pressure or no longer holds. And I'm going to start by showing a scatter plot of nominal growth for a whole bunch of different countries against the listed sector's revenue growth. So the question I'm asking here is faster growth associated with faster corporate revenues? If we've got a better economic environment, does that mean that the top line of revenues, the listed revenues, the revenues from the stock market, is that growing any faster? And if it were a one-to-one relationship, and that would mean for every unit of economic growth, a unit of sales growth. And I've put the line of one-to-one on this chart. And you can see that for a whole bunch of countries on the left-hand side, there is actually a pretty good, that does actually hold fairly reasonably well. In other words, every unit of GDP growth does indeed translate to faster corporate growth. But when you move over to the right-hand side of the chart, you'll notice that there starts becoming a bit of slippage. For those countries in the green circle, you will notice that for every unit of GDP growth, they're no longer getting a unit of corporate revenue growth. I have actually left out one country because it didn't even fit on the scale. And if I change the axis, the x-axis, you will probably guess where I'm going with this. But in Russia, and I put this work together back in 2018, a long time before the invasion of Ukraine, in Russia, you required 3 units of economic growth in ruble terms to generate 1 unit of revenue growth in ruble terms. So a huge amount of slippage. And of course, the question becomes, well, why is that? Why do certain countries not have that one-to-one relationship? where is that revenue growth going? Where is that economic growth going? Where is what's causing that difference? And essentially there are two explanations. One is benign and one is less benign. The benign explanation is that the stock market, which is what I'm using here, is a very different makeup, very different constitution, if you like, from the wider economy. So that's the benign view, that the stock market doesn't represent the wider economy. The wider economy can grow really fast and it doesn't necessarily need to impact the stock market because they're different things. That's the benign view. The less benign view is to do with degrees of corruption and essentially bad governance standards. And I try and demonstrate that less benign view as being a big part of the issue on the next slide. And on the next slide, I'm going to plot each of those blue dots, each of those countries, how far away they are from the black lines. I'm going to plot the distance of those blue countries, each country from a black line, against the World Bank Corruption Index. And you can see that for many of the countries which score fairly well on the World Bank Corruption Index, that one-to-one relationship is actually pretty good. But as you go into the left-hand side of this chart, where the corruption scores, according to the World Bank, get worse, you start seeing that slippage. And this is a kind of the first demonstration I want to kind of show today of how incorporating things like ESG can actually improve the long-term forecasting that asset allocators like myself often publish and often use in behalf of their clients in making investment decisions. Because what it means is that when we start projecting out an economic environment for a country, and we're translating that into the asset class returns that that country's stock market might deliver, we should be putting it through a lens that allows for things like, in this case, corruption, but in other cases, ESG, to translate that economic growth into the revenue growth. So from most of the time, I'm thinking about it from that point of view. In other words, how can we make our predictions for the next 10 years a little bit more accurate? And I think we can make them a little bit more accurate by including dilution effects, if you like, from things like poor governance scores. But there's another way you can look at the same information, which is if you think a country has just embarked on a reform program and it's going to start improving its scores, you can start saying, well, that will also have a implication for how much benefit the investors will have from that reform program. So there are other ways we can use this information as well. It starts being quite powerful, and it starts also allowing us to say to potential governments or to potential investors, you know, this is what we're looking for, and this is the benefit that it will bring. So that's the example from the corporate sector. I am now going to change tack a little bit to talk about an example from the government bond sector. So moving from equities into fixed income. I think perhaps in the interest of time, I'm going to skip ahead a few slides to show a composite that I have sometimes used to improve the scores. So in other words, the last exhibit I showed was just about governance. I think there's much more we can bring into it than just governance. So I'm going to flick ahead a few slides with the intent of trying to demonstrate whether or not countries that have less sustainable policies, if I can put it like that, have to pay a premium to borrow money. So in other words, if you're a bad country that's scoring poorly on ESG, do you have to pay? Does the government have to pay extra for its behaviour? And I believe the answer is yes. I'm going to skip ahead and show you the sort of the composites that we tend to use, which bring together not just the governance, which I showed on the last slide, but also environmental, social, angles as well. And just to talk through the composite measures that we're creating here, these are country-based scores again. So again, we're not talking about companies, we're talking about individual countries and whether the investors into individual countries are demanding a premium for certain types of poor behavior, if we can put it that way. So I'm going to explain a little bit about what's inside each of these wedges: the orange, the green, and the orange, the blue, and the grey wedges on this screen. The composite that I'm using here is built out of readily available information on individual countries. For the environmental score, we have used the Yale University Environmental Performance Index. That itself is a composite of things like carbon emissions, deforestation, air and water quality, etc. I think it includes about 24 different categories of score, so it's a very wide-ranging score in itself. The social score that we are putting in here is an attempt to try and bring in things like inequality, educational attainment, human rights and female participation. For instance, we use things like the Gini coefficient to measure inequality. We use the PISA rankings of educational attainment. We use the female participation in the labour force to try and capture some sort of diversity angle. Again, to try and build up a country's picture for its social scores. And then finally, as we just seen on the governance side, we tend to use the World Bank scores, which measures things like corruption, the rule of law, the quality of government, etc. And when you blend all those scores together, you can see whether a country has to, whether that influences the rate of interest that a government has to pay on its borrowings. In other words, its government bond indices. And on the x-axis here, I've got that composite ESG score. And on the y-axis, I've got the typical 10-year bond yield, so the typical yield that a government has to pay to borrow for 10 years. And the remarkable thing is when you blend all those elements together, you actually get a pretty decent relationship, demonstrating that this type of information, this type of country-based information, is actually pretty important for investors to be thinking about. We've actually tested this to strip out, to see how this type of approach, just looking at ESG scores, whether that is better than or how that helps or is different to more conventional measures, looking at things like inflation, looking at things like economic growth, etc. So whether this type of ESG approach is additive to a more conventional approach. And in our view, it is actually additive, and it does actually help improve predictive power. And so again, this is also trying to demonstrate the importance when making those long-term forecasts, not just to think about them in pure economic terms, but also to think about ESG for each particular country, each particular element of those country scores. Now, I'm going to see whether the technology has started to work for the second poll that we have, which I think is on the next page. But the second poll we have is whether or not, or rather, which factor from ESG do you think would have the greatest weight in a framework, or should have the greatest weight in an investor framework? Is it the environmental factors? Is it the social factors? Is it the governance factors, or should they be equal weighted? So equal weighted was our starting point too. And when I did this work back in 2018, it was that was our starting point. But what we actually tended to find was it was the governance factor which tended to have the greatest influence. And when we started to include this type of framework into our own long-term forecasts, roughly speaking, that was what we ended up doing. We ended up putting a little bit more weight on the governance factors. They seem to have a better predictive power in terms of explaining how things like equities and bonds behaved, and assuming that would hold in the future, that's what we did. So we ended up double weighting the governance factor and having the environmental and social factors fairly equal. But I have to say, it is fairly subjective, and you can come to a different answer by looking at the data in slightly different ways. So, wrapping up the session before the Q&A, what I hope I have tried to show you today is something of the road less traveled. Most investors think about sustainability and responsible investing in their stock selection programs. In other words, when they weigh up whether to invest in Unilever or weigh up whether to invest in Nestle, they'll be thinking about the ESG scores of those types of situations. And what I hope I've shown you a little bit of is that looking at country scores is also very important. And looking at country scores, not just company scores, is a really powerful way for asset allocators like myself, who sit there making decisions about whether we should invest in China or whether we should invest in US equities or whether we should invest in UK equities. We should be thinking about the country scores as well. And the ideal method to be, the ideal framework, in my opinion, that allows that country-based score to come through is through that long-term forecasting approach. And I'm going to end with a cautionary tale, which is what happened to foreign investors into Russia. And this obviously is very much a country-based issue, or was a country-based issue. And it didn't really matter whether you were invested in Sberbank or Gazprom, everything fell together. Now, Sberbank, it turned out, or Sberbank, I should say, had some quite good ESG scores at the company level. Gazprom obviously didn't, but Sberbank had some quite good ESG scores at the company level. But just thinking about these things from a company level didn't help in the final in the event of the Russian invasion of Ukraine. Everything tumbled together. And if you like, that is the cautionary tale, which tries to demonstrate that thinking about the country is also incredibly important. And that is something which I very much hope investors, I very much feel investors have an opportunity to do in an increasing fashion. So on that, I'm just going to say thank you very much, and I hope you've found that interesting. I'm very happy to take questions and to see if there are any thoughts or observations on what I've shown.
Thank you very much, Christopher. Rodion, would you like to start with Q&As? I think there are things in the chat and probably on the Q&A as well. So I'll let you lead that, please. Thank you.
Yes. So let us give our participants a few minutes to collect their thoughts and write down the questions for Christopher. Thank you, Christopher, for this exciting and very informative presentation. And when I was listening to your presentation, I thought that the country level scores would make absolute sense, and it would actually fit with the sort of some of the academic research that we have about corporate governance effects. So we know, and academic research shows us, that country effects in many ways dominate firm effects in corporate governance. So in other words, differences in corporate governance outcomes across the world are to a large extent explained by differences across countries, rather than by firm level heterogeneity. But this literature focuses specifically on corporate governance effects. Here you're talking about more broader perspective, bringing E and S factors into very, very important factors currently into the picture. So do you think there is a gap between the academic literature and practice of ESG? This is sort of, I guess, the first question to you. If yes, how can we reduce this gap?
I would say that the first observation I would have on much of what is published is that a lot of what is published is at the company level and less at the country level. So lots of studies out there, both within the industry studies and with academic studies, that look at the look at ESG for individual companies. And in your opening remarks, you talked about having tilts, for instance, in portfolios. You talked about risk management in portfolios. Often those phrases are interpreted to be at the company level rather than at the country level. I guess, what I've been trying to show here is that it is important, as well as to think about individual companies, to think about the country. And I said in my introduction that I in the work that I've seen, perhaps 95% of it is at the company level, and there's a good reason for that. And I suppose it's fair for you to ask, well, why isn't it more popular to look at countries? Why isn't it something which is incorporated? And there's kind of two reasons for that. The first is data challenges. There are, for individual companies, there are a huge amount of data provision of different quality. Some is high quality, some is low quality, but there's a huge amount of data provision. And there's also regulatory, as much as anything else, regulatory obligations to use company information. There are huge amounts of, there is almost an established way of looking at companies that has been established and has been accepted as by the industry. For country data, it is far more open to interpretation. There are many different ways of looking at countries. There are lots of vested interests, some of whom are quite powerful in pushing their country ranking up or their country ranking down. That is an issue. And there are, when I've been through and selected different ways of measuring countries, there are lots of less good ways of measuring countries out there, which can confuse the picture. So one issue is data. The other issue, and this is probably the bigger one in some senses, is the big trends that investors like me have to face on a day-to-day basis. Sometimes are so big that people don't want. Let me give you an example. Right now, one of the big themes in markets is the Magnificent Seven. This is the Nvidias, the Amazons, the Teslas, the huge US tech companies that have just done so terrifically well in the last 5 years, and maybe 10 years as well, in markets. And it's been very difficult for any investor who wishes to stand against that. It's been a bad thing for their clients and their own business prospects. And of course, if you're starting to use country information, you are tilting against some of those ideas. And another idea which might fall into the same category, perhaps 10 years ago, the rise of China was very, very fashionable in portfolios and investing world. And again, looking at China through an ESG lens was arguably somewhat problematic. So there are some sort of other issues. Now, I think those issues can be tackled with sensible implementation. They are not insurmountable. For instance, The way that I've often done it is to parameterize clusters of countries. So to look at an emerging markets as a whole, to look at developed markets as a whole, and not to allow this scoring mechanism to shift capital from emerging to developed or vice versa. So there are ways of parameterizing it to make it much more user-friendly and digestible, if I can put it like that. But those are probably the two big reasons.
Thank you very much, Chris. Thank you. Questions are coming into our chat. So I think I'll start with the first question that Frederick asked about country factors. So Frederick, it's probably a comment as well as a question. A more state-controlled economy is likely to have a weaker economic growth, corporate revenue, a link due to state control. So that's his Frederick's hypothesis, which in turn is linked to corruption. Would you comment on this, Christopher?
Completely. I 100% agree with that. But I just want to flash back to this slide I pulled up, because I just want to emphasize that ESG isn't the only thing an investor should think about. Of course, you have to think about other issues like the type of market, whether it's a state control, whether it's not state control, the levels of innovation, the levels of productivity, etc. And all of those assumptions, all of those issues would be things that a sensible investor should think about. So for instance, productivity trends would definitely be one way where a state-controlled country might have different productivity trends, and that would have knock-on implications all the way through this, all the way through the thinking on this slide. So 100% agree. My observation is that on top of those conventional economic models, we can incorporate, as well as an additional factor, ESG, and ideally we will see improved forecasts coming out.
Thank you, Christopher. So the next question is from Karine. Karine is asking, I think, a very good question. So why, if the E, the S, and G factors are so different, does it make sense to weight them, or we should analyze them separately?
I suppose at some level they have to be incorporated into a long-term framework. And whether you do that incorporation using an explicit weighting or whether you incorporate using an implicit weighting is a matter of debate, and absolutely you can do it in different ways. I'm not saying my way is the only way, or the way that I've shown here is the only way. There are many ways of doing these things. Each person, each investment house, as I put up on there on those slides, will have their own ways of doing this anyway. I'm just talking in general terms. In general terms, I like to make, in the work that I've done, I tend to like to make the assumptions more explicit, and therefore, if we have an explicit weighting being used, I find that more transparent and more explicable when people ask me questions. What is the weight you put on the factors? If you use an implicit weighting, and you will have to use an implicit weighting if you're not taking explicit weights, you will have to decide to what degree is E going to influence, to what degree is S going to influence, to what degree is G going to influence. If you use an implicit weighting, you will still have to decide on those degrees, but it may just be less explicit, and therefore the model may be a little bit less transparent. But I agree that's ultimately subjective, and you can decide however you like to do it. So there is no one way of solving that problem.
That's a very good answer. Thank you very much, Christopher. So what do you think? I think well, I'm afraid we have the time only for one further question. So our last question come from Ruth. So Ruth's question is about greenwashing. So to what extent you consider greenwashing to be an issue at a country level? Because very often in the news, greenwashing is considered to be a firm level factor rather than a country level. Do you think that there is a country level factor that, because I think you've mentioned the influence that countries have on the ranking as well, or they would love to see themselves high up or down the ranking ladder. So can you comment on that, whether greenwashing is the country level factor?
Yes, I mean, there is no perfect data source, and there is no ideal. There's no one way of doing this. And whether you look at company data or whether you look at country data, this is an issue. And just to talk a little bit about companies, you may have come across scope 1, 2, and 3 carbon emissions, for instance, which is the degree to which every company thinks about their carbon footprint and how far down the supply chain they go. It's very hard to get good quality data at the level 3 level, which is the more inclusive level. And there are huge incentives for companies to report lower carbon emissions, and so that is certainly an issue for companies. No doubt it is also an issue for countries as well. The approach that I've tried to take to it is to use highly prestigious, if I can put it that way, well-recognized indices, things like the Yale University Environmental Degradation Index, things like the World Bank Corruption Index. These are sort of official measures, and yes, I'm sure that those measures have imperfections, but I've tended to take a view that when you take a composite of those, some of the noise, however that comes about, is sort of averaged out, and you get a reasonable score for each individual country. I have to say that I've looked at indices which and rejected them, which aren't so good. And one in particular sticks in my mind, where there was an index of environmental commitment, which kind of ranked countries by certain features. One of the features it used was how many conferences the government went to on environmental standards. And the more conferences you went to, the better your score. We rejected that index. We did not think that was a good index to use. I don't think trying to save the planet ultimately is about conferences. It's about real world action. So definitely there is issues around the data quality. And as I say, our approach has been to try and look at the more well-respected and more institutional quality indices out there.
Christopher, thank you very much for this fantastic discussion and your thoughts on these issues. And I think I'm handing over to Ali.
Yeah, thank you. I think there are a few more questions. I have a question, but I don't think we have time. So Christopher, maybe I'll ask that question via an email. But it was basically about the interaction between company level ESG and the country level ESG, because there are many examples where you can find companies doing some things in a developed country, but completely opposite in an emerging or developing country. But I think that we can discuss maybe at some other point in time. So overall, I would like to thank you, Christopher, for this excellent and insightful presentation. And I'm really confident that your enthusiasm and expertise, which was reflected in your presentation, I think it has encouraged many of us to explore this issue of ESG further, especially country level ESG. I agree with you that most of the academic literature is very much based on company level data. So thank you very much for drawing our attention to that. And I would also like to thank our audience today for their active participation. And with that, I think we can close the seminar. So thank you, everybody, and have a wonderful day.
Thank you very much. Been a great pleasure.
Thank you very much.